Welcome back to Fast Money. Stocks posting their second worst day of the year after what has been a major run for the market, with the S&P 500 falling back into correction territory. Today's sell-off sparking fears the New Year rally may have come too far too fast. Bob Pisani is at the NYSE with the latest. Hey, Bob.
Hello, Melissa. You know, the fundamentals have, for the moment, put a halt to the rally. But the technical picture really has been pretty stellar recently. For example, the NYSE advanced decline line has been steadily marching forward and is close to a new high. 52-week lows, which was a major problem at the end of last year when almost half the S&P was at a new low on December 24th, they've essentially disappeared as the market has risen. That's a very important technical indicator. What's missing here are breakouts on the upside. For example, there's only 3 stocks in the S&P 500 that hit 52-week highs today. We've got to do better than that for a real breakout. Still, the trend lines have been strong. So after dipping below the 50 and 200-day moving average on December 3rd, that was really the start of the December market volatility. The S&P crossed over its 50-day moving average last Thursday before dipping briefly below it today. Again, still generally positive in the last several weeks. The VIX has gone full circle. It was 17 in the beginning of December. It went to 36 on December 24th, and then all the way back to 17 before moving up to 20 today. Really, today is the first significant update for the VIX since that December 24th close. Despite today's drop, the uptrend for the S&P is still intact. That uptrend began on the December 24th bottom, was tested on January 3rd when the S&P dropped 2.5%. But to seriously break that uptrend for this remarkable rally, we'd have to drop below 2610. That's still about 20 points away. So what this means is that technically the market's at a very important inflection point. If we stay at the trend line or even find some support here, that would be a real positive. If we break decisively below that, I'm talking 2610 around there, a lot of people are going to eager to say we'll retest the December lows. There's a lot of that talk around. You know that, Melissa. Back to you.
Yeah, all the banks out there are saying that right now. Bob, thanks. Bob Pisani at the New York Stock Exchange. So this is all happening just as we're hitting the thick of earnings season. So in terms of the ones that you're watching, Tim, I'm curious, which ones are you saying that could be make or break here?
Well, you know, are we talking about the overall market and which stocks that have rallied back in this market and where earnings are critical right now?
Sure, yeah.
I mean, I think you have to go to consumer discretionary. I think you have to look at some of the luxury brands that, to me, have been, you know, outperforming. We're waiting to get, you know, some of the auto guys that I think will reaffirm where the consumer spending is. Right now, to me, if these guys are reaffirming 2019, that is very, very bullish because 2 months ago we didn't think they were getting there.
Yeah, Karen?
I don't know. Some of the names, like a Home Depot, I think is indicative of so many things: housing, retail, consumer, all of that. We're not going to see that, though, for another few weeks.
Yeah.
Really quickly, Caterpillar on the 28th, which I guess is next Tuesday. I mean, that's going to be fascinating. People will talk about valuation being compellingly low. It's going to be fascinating to see what they say and what clarity they have given the backdrop of this China trade thing.
I think it's what we got, not what we're going to get. That's more important. All those large cap tech names I think are really interesting. They did the heavy lifting all the way up. We have to have them to do the lifting again.
All right. Our next guest says despite the sell-off today in this vulnerable market, there are 2 stocks that could be on the cusp of a major breakout. Chris Verrone of Strategas Research Partners is over at the Plasma to go off the charts. Hey, Chris.
Hey, Melissa. And yeah, let's first start with the S&P. Let's talk about where we are. Let's put this in context. So we had 60 days down, and we've had 16 days up, and it puts us that 2630 level exactly where we were at the start of last year. We think we're in a range here. I think the 200-day near 2740 is likely to cap gains for now, and I think that 2500, 2550 level is going to be good support. So within the context of this 100 or 200 point S&P range, what do we want to own? We want to focus on leadership. We think Nike here is a great example. This is a stock that has already taken out where it failed in October and November of last year, and it's a stock that's making new relative highs versus the S&P. This is a leadership name. Sticking with consumer, here's Chipotle, another example, a name that already had its bear market, down 60% over the last several years, putting in a big base here, starting to break out above that 475 level, and again, importantly, outperforming the market the whole time. We want to own leadership. What's not an example of a leader right now? Aerospace is a questionable group here. This is UTX, has not participated in this rally, making new relative lows versus the S&P, remains below its downward sloping 50 and 200. We think this is a vulnerable one. Stick with consumer, Nike, Chipotle, two great examples.
Chris, why don't you come on over, join us here at the desk. Thank you, Shelby, for bringing the chair in.
Welcome, sir.
So Bob was talking about all sorts of technical indicators
Yeah.
prior to your segment, and I saw you over there.
You
You're
agree?
assessing Bob's work, and I'm wondering, yeah, exactly, if you agree. And where do you see that? Because when I start thinking about the markets, I think about so many people saying we should have never been at the December lows. Maybe we should not have been at the October highs either in the market.
The price is the price, right?
Right.
So what the market prints, the market prints. I don't think 52-week highs right now is an appropriate metric to evaluate breadth right here. We prefer to focus on 1 month highs, right? Let's start with a low bar after the big drawdown that we saw. Last week, about 70% of the S&P made a 1 month high.
70%.
70%.
Breadth.
When you start to get readings over 50%, your forward returns over the next 3, 6, and 12 months tend to be better than average. So we welcome some of this expanding breadth over recent weeks.
So just looking at the charts, I mean, that UTX chart looked so bad
Yeah.
is that good at some point? I mean, it's really along the bottom of where the relative performance to the S&P.
I think we're at a spot here where the S&P back up into resistance where we need to focus on what is exhibiting leadership and what is not. Defense is a group that really has underwhelmed us over the last several weeks. Look at Honeywell, look at Lockheed. They really haven't shown up. Conversely, consumer's been pretty good. And I think especially some of the restaurants, some of the footwear stocks. So there are clearly pockets of leadership. And I think in markets like this that are largely range bound, you got to focus on what is leadership and avoid what's not.
But the market relative to itself, so we get extreme drawdown in December, and therefore we've had almost a V. But I could make an argument that we do have to trace it back from at least October, and we're in a downtrend line that actually has not been broken to the upside. And is that am I glass half empty, or is that right?
No, that's true. I mean, the slope of the 200-day is still downward sloping. The 50 is underneath the 200. So the primary trend here is still down. The burden of proof right now is on the bulls. I thought last week was a good start, right? Getting 70% of the index making a 1 month high is a condition you tend to see coming off lows. That's a start. But there's more work to do here. There needs to be persistency of breadth, and I think that's the key moving forward.
Last quick question.
Yeah.
Do we have to retest the December lows?
I think the term retest is widely overused here. Number one, retests are never fun. No matter how well
Well, to
orchestrated.
December
They weren't in
lows
school, I can tell you that,
particular.
Chris.
They're certainly not. I took my share of retests.
Yeah, I
and they're not
retested
fun.
a bit here and there. It wasn't so much fun.
I think we need to be very careful kind of what we wish for here. I would argue 2,500, 2,550 would be a successful retest, even if you don't go all the way down. Remember, this won't be a fun process. It wasn't a trivial drawdown. I don't think the bottoming process will be trivial here either.
All right, Chris, thank you. Chris Verrone of Strategas.
Although I'm negative, I mean, Nike is fascinating. I mean, we're at levels now. I think Nike closed around $80.50 or so. That was the level, I think, when Nike came out and announced the Colin Kaepernick ad. You know what happened after that. It gave a lot of it back over the course of the last month or so. Now we're within a whisper of an all-time high, and a tape that's been, until recently, pretty negative. 26 times forward earnings makes it expensive in this environment, yet Nike continues to grind higher. So he might be onto something with that. It's very hard to fight against that right now, given it's traded well on a lousy tape.
I'm not as hopeful as Chris is on the S&P. I not only think that we retest, but I think that we break it. I don't think that we're going to get that retest that's 2,450 or 2,500. I think we're going to get that test.
Does that mean
that's
everything you said was wrong?
No,
All right,
no.
what do you like?
It's everything. Where do we bounce from there? And I think we trade down to 2,200 in the S&P.